Now, when we spoke in January about this company, and welcome to this edition of All About Your Company, when we spoke about Forgings in January, we suggested that the CV cycle was turning around. And when you look at the stock price since January, we are up 80% on the stock price. And therefore, you've seen a very strong surge. And that was anticipated in January itself, which is why we had that conversation. But we're going to revisit now, just given the kind of rally on the stock and how things have panned out. There are still a few things which are remaining unresolved. And the first part of that is the fact that you've got a 16,500 ton forging line, which yet has to come on stream. That was supposed to come on stream Q1, Q2, FY27. Now it's pushed to Q4. So you want to try and understand whether that forging line will come on stream or not. There's strong demand coming in from the US. The US tilt has shifted. Sustainability of that will be crucial, and for that, this will be essential to ensure that you're able to cater to that demand. Point number two, you've got EBITDA margin guidance at 20%, right? Growth was expected to be at 20. Now the growth guidance has been tweaked to 18, and the EBITDA margins have come in sub 18. So there is a little bit of a bridge which is anticipated to happen. Some part of it being the elevated freight costs, and that we'll try and quiz management as to what's playing out and how quickly can they bridge that gap from 18 to 20% in terms of EBITDA margin, and clarify on the revenue growth guidance as well as to what's causing that slightly lower number. Is it the higher base of FY26, or is there something structurally which they are somber on? The last piece is with regard to working capital to revenue target. This is essential because what is happening is this has been stretched. Earlier, this working capital to revenue was at 23. Now it's at above 30, which means that there's a larger amount of working capital required by Forgings, and with the kind of growth they're doing, that means that more capital gets occupied there. So we'll try and get a perspective as to what's playing out with regard to working capital. Now, last off, I want to quickly take you through the company. While this was discussed at least 8 months ago, I'll quickly take you through it. What it does, it makes and machines steel forgings for vehicles. It was founded in 1946, but actually started its forging business only in 1974. Headquarters are in Chennai, Tamil Nadu, and it's in the castings and forgings industry, very much linked to CV and auto ancillary. What the company does, very simply put, it heats and hammers steel into engine and axle shapes. These shapes are typically called forgings. Of course, it then machines those forgings to finish them, provide that finishing. The machining means cutting them to the exact size and shape as required by their customers. It sells these parts to the vehicle makers, which is the OEMs, and not car buyers, of course. And its edge is the deep machining plus new heavy crankshaft press that they have. I'll talk about crankshafts in just a bit. In terms of the products, I'll quickly take you through them. Forging for trucks and buses, which is one of their largest in terms of component. Second is for tractors and off-highway machines. Then you've got the cars, which is a smaller share. And then there's machined components, various components of an automobile. Pretty much all of them is what they are able to do. And last off, there is crankshafts, which is essentially the rotating piece of the piston. And that's basically the heart of the engine. And they are now into new heavier crankshafts as well, which is niche, and it's rarer in terms of the capability. Volume, currently the expectation is 90,000 plus tons this year, FY27. The target is by end of FY27 and FY28, you'll be between 100 to 110,000, medium term 120, and by FY30, 150. So likely you're going to see a continued growth clip, and by FY30 the goal is to get to 150,000 tons. Of course, there's been a delay this time around, and we'll try and quiz management as to whether they can live up to that or not. Quickly on the business model, they basically buy alloy steel billets from steel makers. The manufacturing, the forging, etc. happens in-house, and customers are like vehicle OEMs and tier 1 suppliers. It's completely B2B in terms of the business. Pricing is sensitive to steel prices, and custom parts are developed jointly with client and engineering teams. and thereafter designed and put out. Where do they sell? 61% is domestic, 39% is international. 9% was the US share last year, but there was a headwind with regard to tariffs. That has unwound to a large extent in Q1. You've got 18% US share now versus the 9% that is visible on your screen. So this has now changed. Europe has come down from 21 to 14, and they export to approximately 15 countries, and they've got clients across. Let's talk about the financials now very quickly. Top line growth has been muted last 3-year CAGR, but that changes FY27. That's what the management is guiding for, and very strong guidance put out. 1% EBITDA growth, we're neutral because we've seen a prolonged period of no growth, but now growth is expected to kick back and kick back strongly and firmly. That's how EBITDA has shaped up. PAT is actually down 8% on a CAGR basis. You've got higher depreciation, other expenses, as well as interest costs, which are hurting profitability versus EBITDA. But talk about the Q1 FY27 performance. This is where it starts to change, right? You've got 16% top line growth, 19% EBITDA growth, margins getting better YOY by nearly 50 bips, and you've got profitability which has surged. So we'll get a sense as to how this plays out for the rest of the year. Margin trajectory now in front of you, or will be in front of you in a minute. There you go. So margins have sunk. 3 reasons why. Higher depreciation, of course, won't impact the margin number, but higher other expenses, I beg your pardon. That's where the impact on margins is, and higher power costs. Power and fuel costs have surged, due to which you're seeing that impact on margins. Will that change or not is the question. But for the moment, that's how the margin trajectory is. The lift is towards 20, and 20 plus is what the management is guiding for. Balance sheet, you're looking at 975 crore in terms of the equity base. So it trades at around 3 times, just above 3 times book. 3,100 crore in terms of market cap. You're seeing the borrowing number at around 1,070 crore. So it's a large borrowing. The gross borrowing number is around the 750 to 800 crore number. That is what the management has said. This is, of course, short-term plus long-term. You've got a cash bank balance of around 225 crore, which sits in the balance sheet. Let's talk about the cash flow. The cash flow has been very moderate. I mean, you've got a thumbs up there in terms of at least the cash flow from operations, but the question is that your working capital cycle has gone up, which is why you're seeing a little bit of a drag in terms of the cash flow. That is expected to unwind. Timelines not given. We'll quiz management on those timelines. In terms of return ratios, you'll see largely it's sub 15%, and therefore we're neutral with regard to this one. But also the multiple isn't too high in terms of the price to earnings multiple, and therefore we've given this a neutral. Typically, you would want higher ROC in terms of the businesses from India. But of course, then it depends on the multiple that you trade at as well. Shareholding pattern, 56% in terms of the promoter holding. No concerns at all there. Good skin in the game for promoters. You've got 2% FIs, 8% DIs, and 34% public. And when you're looking at analyst recommendations, it's 2 analysts. We're neutral on that because of the lack of analyst coverage, but it's a very small company as well. So therefore, that's understandable. 2 buy calls, 28% upside is what the analyst view is. Valuations, 1 year forward, trades at 20 times. The 5-year average is 15 times, so trades at a premium. When you're looking at the 5-year range, it's 9 to 21, so higher end of the band. But when you're looking at some of the competitors, you've got RK Forgings, which trades at 44 times 1 year forward. Bharat Forge, 52 times. Of course, they do slightly more differentiated product as well. And CIE Automotive trades at 15 times, which is a discount, right? So broadly, that's how we stack up. But let me bring on board the management. I'm going to slip into a very short break, bring on board the management on the other side of that break. We have Vidyashankar Krishnan, who's Chairman, Managing Director, who will join us. Mr. Shankar, I'll come to you in just a couple of minutes. Need to take this mandatory commercial. But hopefully we set this up well for you. Plenty to talk about. Stay with us. Welcome back. We're analyzing Forging. The stock has given an 80% return year to date, doubled over the last 12-month period. So been a stellar performer. But there's plenty of growth out there. And let me bring on board Vidyashankar Krishnan. He's the Chairman, Managing Director at Forging, joining us this morning. The first thing I want to understand is the 16,500 ton press line that you were going to put out. You've pushed the timeline for that to end of FY27. Talk to us about what has happened, and does this in any meaningful fashion change your larger growth plan towards 150,000. What is the risk of that getting delayed?
Thanks, Harsh. Thank you for a very rapid fire intro about Forgings, covering all aspects. You
Thank
really
you.
sounded out quickly. Yeah. So the 16,500 ton press was due to be commissioned by Q1, Q2 of this year, has been shifted to Q4, largely because we received a base for the press slightly later. So that has set the plans a little bit back. And also we had to commission one 4,000 ton press for customers in between. So that has resulted in about 6 months of shift in the timeline. But we have it under control. Our team is fully competent of handling this, and for us, this will be the 25th odd press that we are commissioning. So no great shakes over here, except that the size is larger. Therefore, cranes and heavy parts are much bigger, for which arrangements have already been made. So press is very much on target to be commissioned by going to start production by December and into commercial production in Q4.
So you don't think that, in fact, this is only a learning for you when you scale up from 100,000 or maybe 90,000 odd towards 120 and then towards 150? Do you pick this up as a learning and maybe no delays when you actually try and expand maybe FY28, 29, 30?
Yeah, we don't expect any delays. For our estimates for FY27, in any case, we have not factored any new parts coming out of this press. So our capacity stands today at 120,000 tons. And with this press, we'll move to 150,000 tons. So this year, last year we did 78,000 tons of sales. This year we did 20,200 in the first quarter, should do an average of around 25,000 tons for the rest three. So we should finish this year anywhere around 90 to 95,000 tons. And next year challenge or cross the 1 lakh ton mark and 110 and 120 thereafter. So this 16,000 ton press doesn't hold much by way of our business plans at the moment.
What will your capacity utilization be, sir, if you do close into that 100,000 ton mark, if at all I can ask you?
Yeah. So this year we should end up at 90 to 95. Maybe a tad lucky, we could even touch the challenge 100,000 ton mark. But I would look at 90 to 95. And once let's put it this way. In July, we were almost at an 8,000 ton per month output, about 7,700 tons. So if we look at this for the rest of the year, we are looking at about a run rate of around 8,000 tons each month, and 22 to 25,000 tons every quarter, averaging and totaling around 90 to 95,000 tons. Next year, we start at 25 and carry that through the year and do anywhere between 1 lakh and 1 lakh 5. So this is at those numbers, we will be at about 80% of capacity utilization. These 16,500 would kick in by Q4 of this year, but would go into production, into meaningful production from then on. However, that capacity has not been factored into the sales of FY27 now, and a little bit only for FY28.
Perfect. What, in your opinion, what would derail this? Is demand going to hold up? Is that at all going to be a concern? What could stop this story from playing out?
This time around, the story is across sectors, across geographies. US, Europe, India, everything is running pretty strong. And within India also, you see CVs, which constitute 70% of our revenue, and passenger vehicles about 15%, and non-CV about 15%, which incidentally has risen from around 5% to 15% over the last few years. So all these three major sectors are doing pretty well at the moment. And what we hear from customers is that this trend is expected to continue for the next 12 months, at least. So the demand is pretty strong. What could be a reason for this? On the CV side, there has been a lot of efficiency gains that has been what shall I say, realized by the users of CVs in terms of GST, bringing down barriers, faster roads, the national highways picking up. So, truck transport, for example, from Trichy to, let's say, Lucknow, which used to take 7 days, now takes hardly 4 days. And a fast truck does it in 72 hours or less. So, all these gains have played out. And now, and demand is also picking up. So, we see truckers coming back into the market big time. This is what we hear from
Perfect.
customers, and there is a reason behind it as well.
Right. Let me push you on the revenue number. The revenue number that you guided for the last time was 20%. Q1 FY27, you've trimmed that to 18. Any reason why someone should be worried, or was that just cautious?
No, we were on target. About 20% was the growth, 18%, 22. So long as we are at those numbers, ballpark close to it, I think we'll be pretty comfortable. What also happened in April and May, Harsh, was that a lot of labor wasn't available right across the country.
Okay.
Huge amount of
Okay, yeah, fair point.
labor unavailability, and that resulted in migrant labor particularly. This is not an issue only for Forgings. Right across the board, we saw it
True.
as we came out of the crisis by mid-May. We started to come out. We heard this from across the spectrum. That has
Right.
probably dented our Q1 numbers a tad, but I'm comfortable. The wheel has started to move, and it started to move
Right.
pretty fast. So I'm sure we'll more than make this up in the months to come.
Perfect. The other thing that again, probably just data keeping, I'm trying to understand your gross debt that you suggested was 1,200 crore somewhere midway last year, financial year, FY26. It's shrunk by 450 crore. It's currently at 750 crore. Could you reconcile that for us? Because just trying to understand. Plus, you have a QIP also in the pipeline. What's the timing of that? And the intent, my guess would be to pay down some of the debt.
Yeah. Let me answer the debt portion first. At a net debt level, we'll be at about 550 crores on term loans, and we intend to keep it that way. At a gross debt level, we'll be at about 1,100 crores this way or that, and we intend to keep that pegged for the now, unless we see big increases in EBITDA, and therefore it gives us a comfort factor to increase debt levels. So not that we are cautious about the EBITDA levels, but I'd like to see the EBITDA numbers first before I move on to take more debt. But as of now, our plans are very clear. Keep debt constant and ensure that there is discipline in capital spending, and we focus on capacity utilization. Right across the organization, every one of my 5,000 strong team is focused on capacity utilization right now.
Mr. Krishnan, I'm curious to therefore know, the EBITDA level is at 18%. You gave me the cue for this question. EBITDA level is at 18%. Could you give us some color? Freight costs were higher this time. Has that come off? And second, power costs were also higher. But you've got some headwind from the Tamil Nadu, probably a policy change there, which could be a further headwind. But you also have a tailwind where power costs in general should start to come off. So give us a sense, how quickly do you get to 20%, which is your stated guidance?
18.3 is our EBITDA margin as of now. And we see labor costs have shot through in Q1. We've hired quite a bit since May, and we've restored our numbers by mid-June. So labor costs have come up. Also because we've had two increases that are factored in this quarter. One for the previous year and one for Q1 of this year. Last year, we had our increase for labor coming in only by Q2. So two deltas have come in, plus numbers have gone up. So we intend to claw back these numbers and bring back some more discipline on that front. Plus, we are looking at this robots being rolled out. Our intent is to roll out 150 robots in the next 12 to 18 months. And we have done about 50 of those. So we need to move forward, and that will also rein in labor costs quite a bit. That is one. On the power side, we have seen a substantial increase in power and fuel, with gas costs almost doubling in Q1 due to the West Asian crisis. Now that has tapered off quite a bit, and we hope that normalcy or near normalcy will prevail in terms of energy supplies from the uh, Gulf region. Overall,
Yeah.
we need customers are compensating us for the increases on power and fuel, and some of that has been factored in. Some is yet to be factored in. So that's why you're seeing a little bit of impact on account of power and fuel. Over a period
So
of time,
H,
we'll rein
right.
this increase by better utilization on power, and therefore economies of scale should also kick in.
So is it an H2 story or is it an FY28 story, Mr. Krishnan?
Which one? The increase in
The
EBITDA.
20%
I would
EBITDA
say,
margin. Yeah.
yeah, I understood that. That I wouldn't put an aggressive time on that right now, but we are
Okay.
on the thing to improve. I would say close to FY27, and it will be Q1 to Q2. Let's say H1 of FY28.
Okay. Thank you.
We should be, I think, very
Working
close to
capital
20.
to, right.
Yep.
Right. Sorry, sir. I'm really crunched on time. Working capital to
Yep.
revenue. Does that improve? Does that improve H2? Does that improve FY28? That's been something that you're working on.
Yes, working capital to revenue will improve by H2 certainly. Our target is to possibly improve it in H1 itself, but certainly we would achieve that in H2.
H2, you'll achieve 23 in
H2 of
H2. That's the
FY27,
target.
FY27,
Perfect.
FY20, H2 of this year.
Perfect. Perfect. And you'll achieve sub 25 by H2 FY27?
I don't look at that number specifically in terms of a percentage,
Okay.
but we'll
Okay.
get back to
Fair
where
point.
we were. Also consider
Fair.
this, sir, that we have raised about 60 crores by selling land, and a little bit of more
Right.
land sale
Yes.
is in the offer. So all that will
Yes.
improve our working capital numbers for sure.
Yes. EV business ramp up. If you can just throw maybe 30 seconds of color on that. How quickly does
We've
it ramp
acquired,
up, break even?
sure, we've acquired one customer on the three-wheeler space, and that business potential is about 25 to 30 crores over the next 2, 3 years. This year, the most important thing is for Abhinav Arisal to get off the blocks, which we have, and we are now into in between sample and bulk. We are into, let's say, uh, a higher level of sample range, and we'll be entering bulk by September, October. So once that comes in, Abhinav Arisal will be off the blocks in terms of its sales. But a long way to go because it has a significant overhead in terms of R&D costs and so on. So we are looking at several customers in the PV and in the three-wheeler, both human transport as well as goods space. All this is going to come in over the next few months, maybe a year.
Great. Mr. Krishnan, thank you so much. Very clear in terms of guidance. I wish you all the best for delivery. Plenty to
Thank
do.
you. Thank you.
And
Yeah,
it'll be a
entire
big
team is
turnaround,
behind
right?
us. Yeah.
Yes.
Entire team is with us.
Perfect. Thank you so much. Well, growth coming back will be big because we've not seen that as you saw that in the data. Completely timed out on this edition of All About Your Company. Thanks so much for tuning in.